In my last video, I talked about generally why it's a good idea to put 20% as a down payment for a house, and I want to expand on that. So in this video, I want to talk about additional expenses and also potential risks if you still decide to buy a house with any down payment pretty much lower than 20%. Now, before I jump to it, just a quick disclaimer. This video is not a financial advice. I'm just simply sharing my opinion and experience. However, you're solely responsible for your own financial situation, which of course includes applying for loans, mortgages, and etc. Now, for the most part, if you actually have the 20% down payment or more, then the loan for the house should be straightforward, but make sure you have fixed rate mortgage. Although in some situations actually adjustable rate mortgage could be even better, but that's definitely not norm, and I'm gonna come back to it a little later in this video. Also, and that pretty much goes for any mortgage, as far as the property taxes and the house insurance goes, these funds are required to be on the escrow account. However, most banks actually put these amounts into the loan together. So basically, for most part, you don't have to worry about it because you will just have one payment. Now here is the important part. If you're planning to apply for the mortgage with 5% down, 10% down, or even 15%, basically anything less than 20%, that's of the total house price of course, then the mortgage could be impacted few different ways. First thing, you might be required to pay additional PMI, aka private mortgage insurance. That's of course besides your mortgage payment, and typically the PMI rate is between 0.58% up to 1.86%, and that's of the total loan amount. So for example, let's say you bought a house that is $500,000, and let's assume you put 10% down, which is obviously $50,000, and with private mortgage insurance rate, let's say 1.5%, that would add additional $625 monthly just for the PMI, and that's literally like throwing the money to the trash because it doesn't really do anything for you. It doesn't decrease your loan principal. Pretty much this is security for the bank only. And one more thing with the PMI is that most banks will require you to have this PMI until you finally get to the 20% down payment total, which with 30 years mortgage, which is pretty standard, is about 7.4 years. So yes, in this situation, over 7 years, you will waste $625 monthly. And you most definitely don't want to do that. Also, with smaller down payments, the banks can consider you higher risk, and because of it, give you less favorable term loan, so you may pay higher interest. Now, reason number 3 why you don't want to put small down payment on the house is basically because your monthly payments will be way higher. So with all the other expenses that you already have, it will be more difficult to keep up with the monthly mortgage payments, especially for the entire length of that mortgage, which is usually 30 years. And reason number 4 to have the 20% down payment is that usually with the 20% down payment, these loans are fixed. So for most part, that interest rate will be lagged, whether it is 4, 5, 6, or 7%. Oh yeah, I know, now with current interest rates, the adjustable rate mortgage might be also an option. Let me actually give you my father's example. So even though my dad had the 20% down payment, but he still got adjustable rate mortgage, and originally this mortgage started with 6.75%. However, this was years and years ago, and at that time the interest rates were pretty high. Well, I guess similar to what they are right now. And few years later, this mortgage was bought by Capital One, and at that specific time the interest rates were actually lower. So they reduced his rate to 4%, and then he had 2 more reductions in the rate. So the second reduction was at 3.25%, and finally 3%. Now here is why he was so lucky. You see in his mortgage documents, they could only change the rate 3 times. And yes, it didn't matter if the rate goes up or down. Yes, total 3 times. So basically, because they make these 3 changes, and these 3 changes were actually reducing the interest rate, right now from multiple years already, he's like that 3% mortgage rate, and that rate can never change again for him, because the banks already used the 3 times that they can actually change the rate. However, keep in mind, that's not the norm, and even though in his situation this worked really well because the rates went down 3 times, however with the adjustable rate mortgage, they can go up too, so just keep it in mind. So look, long story short, yes, you can buy the house without any down payment, or 5%, 10%, or whatever down payment you want to buy it with, but if you buy it without the 20% down payment, that loan will be definitely more expensive. So if possible, maybe saving this 20% for down payment will be better option, margin. And even though, yes, it is very hard to save the money these days with all the expensive prices all around, but buying a house with good down payment will not only benefit you financially because you're saving money on interest and the PMI payments, but it will also make your monthly payments more affordable, which is definitely a huge plus when it comes to financial stability. Now, if you're actually saving the money for the down payment, one of the best places is Hyatt Savings Account. Here is my experience with Capital One Bank, and as always, thank you for watching.